Hello, everybody. Welcome to this 2025 Q1 quarterly investor update. I'm Jeppe Kirk Bonde, the most copied popular investor on eToro. If you want to use this presentation for anything, please go ahead and read this disclaimer at the bottom very carefully. So in this presentation, I'll go through my background, my investment strategy, what I have in my portfolio currently, and finally, I'll go through the many questions that I've received in advance. So one of the reasons that more than 30,000 people are automatically copying my investments on eToro is that since 2013, I've had an average annual return on investments of 25%, which is really better than anyone you could fairly compare with. For instance, many of the most famous uh, long-term equity-focused investors. If yeah, both with a better return and a better return to risk profile. If you wanted a higher return than that in that period, you would effectively have to take on a lot more risk. So my background is that when I grew up, I thought I wanted to be a politician. My dad, he was a member of the European Parliament for 29 years and the leader of a political party in my home country in Denmark. And then I started at university studying political science. And then I sort of realized that the power is in finance. So I switched for my master's to study finance. And then I started my career out as a management consultant, advising some of the largest companies in the world, including banks and tech companies. Then, as I was working as a management consultant, I was making more than I was spending. And so I wanted to invest my money. So I made an analysis similar to what I would do for clients as a consultant to compare all the different options for me to invest. So I looked at the different banks, brokerages, what the different pension funds offer, and so forth. And then I scored them all to see, how they're doing in terms of what instruments are available, what the fees are, how good is the app, how good is the website, and so forth. And then based on all of these, eToro came out on top. And then I started investing on eToro. And then as my investments on eToro were doing very well, people started copying me. And then more and more people started copying me. And then in 2018, I decided to quit management consulting to focus only on managing my portfolio on eToro. Then I hired some people and upgraded my systems and got to focus only on this. And 1 year later, I was then the most copied investor on eToro. And then since then, it just continued to grow and yeah, continued to do better and better. And today, 34,680 people are copying my portfolio on eToro for a combined 116 million US dollars. I don't do everything on my own. I have a great assistant who helps me with analysis. I have a good network of experts that I trust. If I invest in something, I must either myself be an expert or know someone who is, so I can get to the important insights fast enough. Then I get strong support from eToro. Whenever I have any questions or concerns, I always know who in eToro to reach out to, and then I can always get help quite fast. Then I subscribe to the best data providers to have access to the best data and use the best IT tools to organize that data in the best way and ensure that anything that should be automated is automated. Finally, I'll highlight my three favorite experts, which are my three brothers. One of them is the CEO of a large marketing company. One of them works for the Danish Ministry of Finance, doing their biggest economics models. And one of them did his degree in computer science and works with AI. So if I have any questions or concerns within those areas, they are my go-to guys. My investment strategy is based on some principles that have been there all along and continue to be here. I focus on macroeconomics, so analyzing and evaluating what kind of growth rates different pockets of the global markets can have in the future. I look at mega trends. So these are trends that I evaluate can grow by at least 10% per year for more than 10 years. I focus on fundamentals. This means really, really carefully analyzing companies in detail, looking through their financial statement history, their products and services. What is the management team like? What's it like to be an employee there, a supplier to the company? What are their different opportunities in different scenarios? What is their technological level? How might they respond to things that competitors might do, and vice versa? And based off of all of this, I estimate what kind of costs and revenues they can have year by year and how much that makes them worth today. And based off of that, I value the company. And then I like to buy companies that I think are very valuable compared to their price. There's a great quote by Warren Buffett: price is what you pay, value is what you get. And that really encapsulates that philosophy of you want to buy something valuable, but you don't want to pay too much for it. Then I focus on the long term. There's a great quote by Benjamin Graham, who was sort of Warren Buffett's mentor and the author of the famous book, The Intelligent Investor. And he said, in the short term, the market is a voting machine. In the long term, a weighing machine. And that effectively means that in the short term, it might be important who thinks what about who and what do some people think that other people think. But in the long term, if a company does succeed, become very big and profitable, then in the long term, that will also result in a either high share price or a lot of dividends paid out to you as an investor. And I have the patience to wait around for the prediction to become reality rather than waiting for how other people might try to predict against others' predictions. Then I focus on risk management. That includes diversifying, so ensuring that my portfolio is diversified across different geographies, different industries, different business models, and includes assets that can do well in many different scenarios. Then I hedge against specific risks. So, for instance, I like to ensure that many of my companies that are using energy have some of their energy price risk offset by other companies in the portfolio that are producing energy. So the consumers of energy and the producers of energy, they sort of cancel some of the energy price risk out for me. Then I stress test the portfolio. So go through different scenarios where different things happen simultaneously, and then evaluate how my portfolio would fare in such a scenario and whether that's okay or not. And then I make adjustments based off of that to ensure that I have a portfolio that can yield the highest average return across scenarios at my risk appetite level. Finally, I focus on keeping fees low. I don't use any leverage. I avoid high fee instruments. I don't do any shorting, and I don't have any excessive trade frequency. I pay the same fees that copyists do. So when I keep my fees low, so do copyists. And keeping the fees low is just another great way of squeezing more profitability out of one's portfolio in the long term. Then there are some areas where I really see great opportunities. I like companies that provide organic growth. That means selling more products and services, increasing the price of products and services by more than the prevailing inflation rates, but it doesn't include companies that are just growing through acquisitions. So sometimes you can read at the annual report that, oh, our company grew 2% this year, but that's only because they acquired another company. Actually, the core business shrank by 4%. So what they've achieved is really not that impressive. There are some companies, though, that are able to build a lot of organic growth on top of some acquisitions. So they buy a small company for a low price, and then after they bought it, then they find synergies with their large organization and then manage to create a lot of growth after the acquisition. Then I like companies that are resilient, that can do well in many different scenarios, not just a few, that have sustainable competitive advantages, or at least a route for how to build those in the long term. I like companies that have strong balance sheets and that can help protect my portfolio against different extreme risks. I like companies that are truly profitable, that are creating value year after year, and ideally are able to reinvest those profits into themselves to grow even faster in the future. Then I like companies that have a new good company strategy. It's not enough that they have a new strategy if it's a bad one. It's not enough if they have a new good strategy if they're not going to actually execute on it. So I need to see some real signs that they are serious about this new strategy. When a company changes its name, sells off a part of the business, or does another big, bold move, that can help prove to me that, okay, they are serious about this new strategy. It's really happening. And then what can happen is sometimes you end up having to pay the price of the old strategy, but you're getting the value of the new strategy. I like companies that have great products and great services because that often makes you win in the long term. If you're a smart shopper and you are able to cleverly compare products, it gives you a tremendous advantage as an investor. If you can go out and buy the correct product instead of buying the wrong product and regretting your purchase decision, then you have found one piece of the puzzle. If you do not understand products well, then it's very hard to also understand companies that are making those products well. A great example of failing at that was when Steve Ballmer, he held the first iPhone in his hand, and he said, Business customers won't like this. It doesn't have a keyboard. It's too expensive. I'm very comfortable with our position. And he was, of course, proven wrong by the massive success of the iPhone. But that was an example of holding the blockbuster product in your own hand and not being able to see that that's the blockbuster product. And many people have recently done the same mistake with Tesla, with Nvidia, and will likely continue to make that mistake with many other blockbuster products. Finally, I like companies that are mission driven, not just because I sometimes believe in the mission, but also because it can be a great way to attract and motivate and retain the most talented individuals. There are some companies that are just magnets for the smartest, most hardworking people, and there are other companies where if such people find, by some accident end up working there, then they'll very quickly get out of there again. And whether a company is in one end or the other of this spectrum really matters a few years down the line. It might not show up in the financial results 1 quarter from now, but it will a few years down the line. Then my portfolio on eToro is almost entirely invested in stocks. And that makes good sense because historically stocks has been the best category of investments. Property has also historically been good. I have a property in Denmark that I rent out, and I also have some real estate investment trusts on eToro. And I know many of my copiers also have property and then are on eToro building their stock portfolio. And yeah, historically, those have been good categories. I think in the future, in a lot of popular property markets, returns are going to be lower because of higher pace of building, while many of the big factors that have sort of been true for many, many centuries are coming to an end. For instance, with the demographics changing quite a lot. So instead of having rising populations, you're suddenly having populations that are more or less going to stay the same. Then you have bonds that historically been decent, but now based off of the interest rates you're getting and the prevailing inflation rates, I really don't think are very exciting. Commodities have historically not really done anything. If you were at the beginning of the Roman Empire and you had one gold bar and then you kept that gold bar and then 1,000 years later you still have a gold bar. The gold bar didn't give birth to any little baby gold bars. It didn't expand into a big gold mining business. The gold bar is just the gold bar. And it's the same with a barrel of oil. A barrel of oil stays a barrel of oil. Contrast that with a company that can just keep inventing new products and services, keep expanding to more places and grow much, much bigger over time. Or, a property where you can keep renting it out and reinvesting that to improve the place and to get another property and so forth. So that's sort of the core issue with commodities, although in the past decades they have performed better than they have in the wider arc of history. Currencies have historically been bad. They are currently bad, and I think are most likely to continue to be bad, primarily because the supply keeps increasing and prices keep increasing. So what you can buy with your currency is just less and less, and so you're basically your money is just dying to inflation year after year on average. So whenever I have an excess of cash, I like to get a transition to the left in this chart and ideally invest it into some stocks. Then there are some macroeconomic drivers that really drive long-term global growth. So I like to split these up into the physical realm, the social realm, and the technological realm. So within the physical realm, I like to look at nature, how many trees are in different countries, how much oil is in the ground, how many, what are the reserves of metals like, and so forth. Then I like to look at life, animals, but chiefly people. What are the demographics like in different places and how are they changing over time? The companies that have the right product for the right demographics in the right locations, of course, have an advantage. Then the realm in which the most value can be created or destroyed the fastest is in the social realm. So when we have a piece of paper or some numbers on a screen or some words in our heads, like a US dollar bill or a deed to a property or a stock, this is all something that we trust in. It's a social construct. And if we believe in this all together, then this can help us cooperate with one another. And it's that cooperation that helps us create so much value. And if that cooperation stops because that trust stops, then there's a massive amount of value not getting created. And that then can cause a big crisis. But then why do we humans value anything? If you have a house, it might be very obvious to you. Of course, a house has value. It's made out of brick and mortar. It's very tangible. But if we humans, we all wanted to go camping and live out in nature, and nobody wanted to live in a house, and nobody wanted to look at a house, then the house would not have any value. And sometimes what we humans value changes over time. And if you find that something is changing in terms of what we value at a rapid pace, even if it's coming from a small part of society, that can suddenly be everywhere. And if you can get in early on that, it can be the basis for very good investments. Finally, there is the technological realms, all the way from the deepest pits of the R&D labs to the final stages of how consumers are finding little ways of using their products better and better every day, adding up to a big change over time. The most important uh, shifts in this category are the foundational technological shifts. So going from hunter-gathering society to agriculture to the industrial revolution, getting the internal combustion engine, getting to the electrical era, to the digital era, and finally now to the era of artificial intelligence. So from those big macroeconomic factors, we can sort of zoom in on how the world economy is doing today. So across the globe, there is an okay level of economic growth, although slightly stagnant in Europe in particular of the big areas. In terms of unemployment, things are actually looking better across the board than they were before COVID. So that's, very nice actually. In terms of interest rates, I think we've hit now a quite moderate, what we could call a new normal level. It's a lot lower than the average interest rates of the long arc of human history, but it's a lot higher than what we've seen on average since the great financial crisis when we hit negative interest rates. So I think now we're at a quite stable level, and this gives a lot of optionality for central banks to say, oh, if we're suddenly seeing inflation pick up a lot, we do have the room to increase interest rates and stop this. On the other hand, if we do see the economy weakening very significantly, we also have capacity to lower interest rate and thus, increase the money supply effectively and get the GDP up, get the unemployment down at the cost of potentially raising inflation a little bit. And having inflation now almost down to those 2% of the official target mean that the central bank is sort of a little bit victorious here. It's not perfect. It's not in the way that, there's zero unemployment and exactly 2% inflation, but having unemployment, in America below 5% and having inflation below 3%, that means you are sort of near to being, you're having a good balance between your two goals. And I think that's quite an accomplishment, and it puts generally central banks in a position that they can give way if either unemployment or inflation should certainly, bring us some very bad looking numbers, and there need to be a response for that. Then there are some mega trends that I've identified as extra interesting. So if a company is driving or riding on the wave of one or more of these mega trends, then it's more likely to be in my portfolio. So firstly, I'll focus on the nice to haves. So when we humans, we have it all, then we like to enjoy ourselves and play games with our friends, compete with others on who can have the better fashion and so forth. And there are companies with great profitability, great growth prospect within these industries, some of which are to be found in the portfolio. The nice to haves are dangerous if that's all you have. They can only really work well when complemented with the need to haves. If we don't have security, then all of the nice to haves, they fall away, and we don't get to decide how our society is run anymore. Similar with energy. Then there are some enablers and accelerators that help us do these things better, faster, cheaper. Chief of these is AI, which is really, the most important thing to consider in each of these other areas is really how AI is changing that over the next years. And the companies that are potentially great beneficiaries of this and really driving this massive change are to be found in the portfolio, along with the companies that are bringing us the next generation of amazing devices that we'll all be using in the future. Then when you've identified a group of companies and you want to get or maintain a quick overview of them, a great way is to look at the multiples. So this is an example of the Magnificent Seven, the seven big US tech companies. So here in the top left corner, we can see that the profit margin of Microsoft and Nvidia are really good. They're really good across the board, but Tesla and Amazon are lagging quite a bit behind on this metric. In terms of growth rate, They're all growing, but Nvidia is growing absolutely massively, while Tesla and Apple can really only be described as having stagnated quite a bit and not really growing. The two top charts here, the higher the better, because they're about profitability and growth. But the two bottom charts, the lower the better, because they're really about price. So for every dollar of profit that Microsoft brings in, we as investors effectively have to pay $26 for a claim on that. That seems quite fine. But for Tesla, we are paying $138 for every dollar of profit, which seems excessively high. We would only want to pay that much more for Tesla if we believe they can really improve that profit margin or get back to a high growth level or something like that. Otherwise, we wouldn't want to pay that much more. If we look at enterprise value to revenue, we can see that for every dollar Microsoft brings in, every dollar of revenue Microsoft brings in, we have to pay $12 when we invest. That seems quite fine. But for NVIDIA, we're paying $28 for every dollar of revenue. However, NVIDIA is also getting more profit out of every dollar of revenue, and they're also growing it a lot faster. So maybe that makes good sense. So that's a way to get an overview with the multiples. I generally like to look at big data tables like this one. I take such data and I complement it with my subjective insights. So I might evaluate CEOs on different factors on a scale from 1 to 10. How good are they at this and this and this? So that's subjective, but it's numerical, and all that can be complemented with one another. And I use that for my financial models, where I take all of that data, I put it together in different ways, and use that to create valuations, calculate how valuable are companies, and thus rank them and see which one should go into my portfolio. And I conduct risk scenarios to see, okay, if these things happen simultaneously as this and this, how would my total portfolio fare if I did it like this or like this? And then based off of that, I can adjust what I need to learn more about. If there's a change that could be relevant, maybe I need to learn more about this new company, about this new factor affecting many companies, or about this new policy, or about what is the future outlook for taxes for this kind of companies, and so forth. So I do a lot of research. That research leads me to find more data and look at more companies. That change causes me to decide to make changes to how I do financial modeling. That causes me to see companies in a new way and decide to do more research. And that's always spinning around. Effectively, every company that I've ever taken a deep dive on has taught me something new. When I invested in Facebook 12 years ago, I did a very long, careful analysis of Facebook. And that didn't just teach me about Facebook, it also taught me about social media advertising. And it got me thinking, what kind of companies are doing social media advertising? Maybe I should have a component in my valuations regarding that, because it seems that the smart companies doing social media advertising and the dumb companies not so much. So maybe that's an important factor to consider going forward. And so with every company that I've valued, I've learned something new, and I've then used that knowledge to apply to how I do valuations and to what data I think is relevant. And so that's sort of just been my process for many, many years, constantly optimizing at the way I value companies. And then that cycle that keeps spinning every day causes me to basically say, what should I be invested in today? And if that's not the same that I am invested in, well, then I need to make the relevant change. Maybe I need to buy more of a stock I already have, maybe get rid of some. Maybe there's a stock I haven't invested in yet that I need to add into the portfolio. And then I shall be clicking the trade button to execute those trades. Then when you add up all those investments, then that is my investment portfolio. And the largest positions in the portfolio today are in TSMC and NVIDIA and Iberdrola. You can always see exactly what I'm invested on the eToro website or in the app. It's publicly available to see at all times. If you compare my portfolio with the US economy, we can see that in the US, it's not just one industry that has all the economic activity or all the great investment opportunities. There's great activity and great opportunities in many different industries. The largest ones in the US are property, professional services, and manufacturing. The largest in my portfolio are tech, energy, and health. Then in terms of geography, my portfolio is slightly more invested in North America and Europe, less in Asia, and especially less so in China compared to global benchmarks. That was my presentation. Thank you very much for listening, and I'll now go through the many questions that I've received. So firstly, how will US tariffs play out through the global market? So when you go through company by company, and the tariffs that are relevant to them that have been announced or could be announced, then there is a lot of sort of devil in the detail where a specific company might have to make changes to its supply chain or to its legal structure to sort of get around that and end up with a sort of much smaller overall impact on the company than the sort of headline number would actually indicate. Then you have, so that's sort of at the company by company level. At the very, very macro level, what's really happening here is that the Trump administration has gotten this slightly wrong economic idea that it's very, very important to close the US trade deficit. So they're going through all the countries that have the biggest bilateral surpluses vis-a-vis the US, vis-a-vis, and then they are trying to find a way to close that. And so they're basically threatening other countries to do something on this front. So Japan got out of it easily by saying, oh, we'll buy more natural gas, so we'll close the deficit that way. And other countries will either have to do something nice for the US or find a way to close this gap. And that's sort of that's what's playing out at the grand stage here. And then what can individual countries do in this regard? Well, you just have to understand that that's the American strategy here, and it's not really the greatest strategy, and you can actually sort of flip that to your advantage if you're really smart and find ways to buy some actual goods and services cheaply from America, and make Trump happy at the same time. There's also sort of I guess we'll get to that at some other questions. What would be your qualifications for a company to end up in your portfolio? So I want companies that I overall, based off of everything value, to be very highly valued compared to their price, that fit into my portfolio to create a total portfolio that's at my risk appetite. So when I invest in a new company, effectively I have to make a change in my portfolio. I want to make sure that this is sensible in terms of a return and risk perspective. Now, what I don't have in terms of qualifications is a checklist. This, I think, is generally a very, very bad style of investing. There are many institutional investors that take this terrible approach where they use a screener and then they say, okay, we only want companies with a good price earnings ratio, and they should only have good growth, and they should blah, blah, blah. And then they do this whole checklist and they end up with a list of 11 interesting companies. And then they think, oh, these must be good because they have all the check marks. And those 11 companies will just be bad investments because there's something else wrong with them that you didn't capture in your checklist. And so what you have not done properly is instead have an actual investment hypothesis for why a company should be an interesting investment, and then analyze it very, very carefully. So those that sort of checklist thing ends up working really, really badly. And quite often, what you really want is a company that really fails on one of those things, but where you are like actually okay for why it's failing it, and maybe that then made others not want to have it, but you are okay with that. So effectively, there are many great investments that have a big red flag in them, but you just got to look under the red flag and be like, I'm okay with this red flag. Actually, this is great. Do you think the SP 500 will return a lot less over the next decade than the previous? The SP 500 has been very great, and I think it is extremely good. I wouldn't bet against America at this stage, and I would certainly not bet against the 500 companies in the SP 500 based off of their current profits and their growth prospects. I think they're really good. Also, now big US tech makes up a very large share of the SP 500, and if they can end up getting a lot of the accruing a lot of the value from really, really good AI in a few years, then it could be absolutely massive. And by having the SP 500, whether that one wins or that one wins or that one wins, you'll have a stake in that. On the flip side, I prefer not just have all 500, but actually pick out the ones that I think are even more likely to be big winners, that have, even more prospects of being more profitable. So while SP 500 is great, a subsegment of the SP 500 is even better. What are your main concerns for the next 6 months? So really, it's all about AI. Whatever other topic you think is important, whether it's climate change or geopolitics or a specific war, the most important thing about that subject is how AI is influencing it. So if you're really, really focused on climate change, right, forget everything about climate change and focus on AI, because that's more important than what you were doing with climate change. Even when your only focus is climate change. So yeah, it's all about AI and how that intersects them with a lot of different other topics. What is your expected return for 2025? I generally don't have any expectations for positive or negative returns in the short term. When I invest in any company, I'm effectively saying that I think the market is on weighted average wrong about this company. I think this company will do very, very well in the long term. And therefore, I'm buying it now. But I don't think that, 3 months later, everybody will see what I saw, or that, 2 years later, they'll all come around to my line of thinking, or, this company is suddenly going to be massively profitable 2 years from now. And that's when everybody will, see the truth. I'm very happy and patient to wait around for a long time for people to discuss and discuss and discuss. But then in the long term, when the weighing kicks in and the company has actually become very, very big and profitable, that's when I then showcase my overall higher performance. And yeah, I have the patience to wait around for that. So I don't buy things because I think other people will change their mind in the short term. I buy it because I really want to own this asset at that price because of how I think that'll deliver profits to me through its entire lifetime. What do you think about EQT? So there's two different companies called EQT. One is a private equity fund, and the other one is a natural gas company. I'm assuming that this question is about the natural gas company, as that's one of my biggest positions in the portfolio. And yeah, I think they're an amazing company. They stand to benefit massively for some of these big geopolitical disruptions that are happening. Yeah, very happy to have that as a big position in the portfolio. How much does eToro charge when closing a trade? So when you are clicking to buy, for instance, Apple, you'll see that there's a slightly different price between the buy and sell. So that little small difference is known as the spread. Could, for instance, be 0.4%. And then if you just buy and sell, well, you would have effectively lost that difference, right? So that'll have been your fee. In addition, when you buy and sell yourself directly, you pay $1 to make such a trade in most markets. When you're copy trading, then you don't pay that fee. So that's a nice extra incentive to copy others. So when I click to buy Apple, then I buy Apple, and so do copiers. But then you don't pay that $1 fee for that trade. So that's just another great advantage of copy trading. Is now a good time to invest in crypto? So I currently have a small position in Bitcoin. I think there are some extreme risk scenarios under which Bitcoin could actually do really, really well. So it can be a nice way to protect the portfolio against those specific scenarios. Not all negative scenarios, but some specific ones. Then I think there is an opportunity for Bitcoin to become really, really useful as a store of value, as a method of purchasing, as a unit of account. Like I really, really want to get to the stage where I can just go and pay with Bitcoin everywhere. And I think the technology exists to make that happen. And it happens at a very small scale, but it could become very, very massive. There are other cryptos where you see some technological changes where they make some innovations that are really cool, and then there are, sometimes you see another crypto has then copied that innovation, and that makes them even better. Hypothetically, Bitcoin is a little bit standing still then, and unless we get a lot of second layer technology support for it, then others might overtake it. But I think it's still the one in pole position. I think that one is really sensible for to have in one's portfolio. What is your view on Ripple? So there are aspects that I like and dislike. I think to some extent it has all the disadvantages of the old banking system, along with all the disadvantages of sort of big corporate crypto. So I don't really like it at all. I do like the fact that it has a total limited supply of 100 billion XRP. So that's the nice fact, I guess. Why do you not use leverage? Effectively, when you use leverage, it's not free. You pay an interest rate to have the leverage. Leverage means borrowing money to invest. And when you're borrowing, you should always ask, how can I borrow the cheapest? And for me, that would not be getting leverage. That would be, redoing one of my mortgages. Then when you use leverage, you're also increasing the risk, depending on how you use, but almost all scenarios, you are increasing the risk of your portfolio. And my portfolio is already at my risk appetite without leverage. So I wouldn't want to increase the level of risk by adding leverage to that, and especially not when I have to pay for it. What is the minimum amount to be able to copy you? So it's 20,000 US dollars. What is the minimum when adding funds to an existing copy? 200 US dollars. What is your opinion on the Chinese current situation? So there are some demographical challenges and some challenges in the property sector and so forth, which are somewhat important. But I think the big important thing with China now is that in a completely free market of competition, China would do really, really well. if you look at the technological level of companies like DeepSeek and ByteDance that have made TikTok, like those products are better than the American competition. And so there's a really, really high performance level there of Chinese companies. And similarly with the, the manufacturing sites and so forth. But there's no longer free trade in the other direction. China hasn't, been free trading towards the Western world. And now basically since Trump's first term, America has turned away from full cooperation with China. So now it's no longer the case where if this is very good for China, but a little bit good for us, we'll do it. Now it's more the case of we need to be aware that there is a massive risk in the global economy if China becomes the new hegemon, and we need to stop that before it happens, even if that means losing out economically in the short term. And so because of that, America is now doing a lot of activity to try to stop the growth of China, and that's effectively what's really, really putting a damper on the Chinese growth prospects, along with those other issues that are then, of course, then made up for by China basically being a really, really amazing country in terms of manufacturing and technology and many other things. How much emphasis do you put on investor psychology? So many years ago, I went through a list of cognitive biases. I think it was 168 or something like that back then. And I reviewed my own processes to ensure I sort of eliminated each one of those. So like, yeah, don't, make a trade decision when you are hungry that you didn't evaluate on some other aspect. Don't get anchored to a certain number and so forth. Many cognitive biases, it's important to weed those out from your own decision processes. Then there are some other cognitive biases that have been added to the list since then, and maybe since I checked last time, even further. I think so. That's sort of one sensible thing to do. But I think there are a lot of investors who are really interested in behavioral finance and in investor psychology that are really just masking the fact that they're really bad investors. They don't want to analyze economies. They don't want to analyze companies. They don't want to really, really do the heavy analysis. So they just think, oh, but I'm a people person. I kind of like humans. I'm interested in psychology. So I can just use this to make investments, play the player, not play the game. And yeah, then they end up doing pretty poorly in terms of investing. And so I think it's fine to be excited about the field of psychology, but it's not a replacement for actually knowing what you're investing in. Do you have a WhatsApp group chat for people who follow you? No. When will Vale start paying dividends again? So if you owned your Vale shares before the 12th of December last year, then the dividend that's currently in the process of being paid out is on its way to you. So I think in March that should be received. And if you bought it after that, then you will get the next dividend after that, but you're not entitled to the one that's currently being paid out. So then that'll likely be 4 months after the one that's being paid out, because they pay out like 3 times per year. And effectively, there's something called the ex-dividend date. So when they record that this is the date for the dividend, then if you own it on that date, yeah, you're entitled to that dividend. And now there can be a long process for it to be paid out, but that's the date that matters. And if you buy the share after that date, right, then you're not entitled to that dividend. And yeah, it's just a bit sad in markets in this day and age that it still is such a long time for dividends to actually, hit your accounts. What is your view on Berkshire Hathaway? So its CEO, Warren Buffett, has had the most amazing investment career of any investor. And it's one of the few companies where I do look at what they're doing. And, he's probably the investor I have myself, maybe second most, but one of them that I've try to take the most from in terms of how to approach investing. And the company itself, I don't have in the portfolio now, but it's one that I track closely and keep a constant assessment ongoing of. Will you anticipate a correction? So potentially, but probably not. And it's not really correction dodging is not my strategy, and it's a bad strategy. If you take the greatest economists in the world together with the CEO of Goldman Sachs and some other people, and you try to get them to predict when we'll have a correction or when we'll have a recession, then they might do a little bit better than a monkey throwing darts. So a little bit better. Okay, so it's a little bit better. So is that then the basis to make your investments? No, because you obviously want to be basing your portfolio on where you can add the most alpha, where you can add new insights to the market that you're getting paid for, basically, where you say, instead of just getting the average return, I'm getting way more than that because I have information that others don't in the market. And if you can find it, I think that the area where you can do that best is really focusing on what's the most important things in the world for the long term. This is what's most important. Yet most people really shy away from that and don't do those analysis. So there's like nice wide open field there to do analysis that others aren't doing that are much more important. And then picking up a portfolio based off of that can give you your average return plus a lot of alpha from those analysis, whereas spending a lot of time trying to do the same analysis that other people are already doing in order to be just marginally better at it than them will yield you, very little extra. And if you're actually trying to be a correction dodger, very often being short the market because you think now it's going to decline, whatnot. On average, you're having like significantly lower than average returns from that. So you're significantly worse than a monkey throwing darts when you do that. Will there be a bear market soon? So that's sort of almost exactly the same kind of question. There are more bull markets than bear markets, and this line of thinking often comes from people that will just never invest. They're just perma bears. They are of the attitude that, oh, the market has gone up. Oh, it must be too expensive. Let's not be invested right now. Oh no, the market's gone down. Maybe it's gonna go further down. Let's not be invested right now. So what changes it, whatever is the big risky fear item on the news, that's what changes. What doesn't change is that they don't want to be invested based off of that. I think if you want to wait until there is a hawkish Federal Reserve policy, good growth, low price earnings ratios, low all sorts of things, to have everything looking perfectly and no negative news in the news, yeah, then you will just wait forever. And so I think you're better off just being in the market, accepting there'll be corrections, accepting there'll be bear markets, and then living through those. And then, maybe when the market goes down by 20%, you only went down by 17%. Maybe when it went up by 20%, you went up by 25, and then you just stack that over many years and end up with a better result. How often do you balance your portfolio? So if you have an exchange traded fund, it does rebalancing sometimes every quarter, where the ETF is itself a mix of actual assets with fees you pay that's mirroring an index, which is just sort of on paper, those assets and how they perform. And they try to get those to be matched up. So when a new asset enters in, they need to sell a little bit and add that in so that the ETF matches the index. And so that rebalancing is every quarter for them. But I don't do rebalancing like that. But I still do what you could consider an act of balancing in that. I'm always adjusting my portfolio based off of potential risks and returns. I do on average 4 trades per week. And yeah, that's my sort of constant adjustments of the portfolio that lead up to larger changes over time. And then yeah, sometimes I do large adjustments of the portfolio. But it's not a rebalancing act in the same way of like an ETF does it on base of sort of a fixed formula every 3 months. What rules do you follow for balancing your portfolio? So I'm always trying to either improve my return or reduce my risk. And so that's my rule. Get the highest return on average across scenarios I can at my risk appetite level. What is your view on Fluidra and the water sector? I'm not really sure you can say Fluidra is in the water sector. They make equipment for swimming pools. I think maybe not this particular question, but I get a lot of questions about the water sector in general from people that somehow have gotten the idea that fresh water is like oil. It's a non-renewable resource that will become very valuable in the future. Or fresh water will be the new oil. And the reality is that the price of desalination has come down significantly over the past decade, and now actually creating fresh water is super cheap. And yeah, and this sort of wrong idea that fresh water will be super scarce in the future is just the basis now for some very bad investments. What is your view on Samsung? So I like it a lot. I think it has good profit, has good growth, has great products. There are some issues that I won't really go into, but yeah, overall I like it. I think it can do really well in the future as well. How will you minimize risk from losses due to the AI industry situation? So I do not minimize my risk of losses from the AI industry. I try to maximize my potential gain from AI while taking an approach where the total risk is acceptable, not minimized, but at an acceptable level. So that if things work out with AI, it should be extremely good for the portfolio. But if things don't work out, it's still okay, although terrible, but not, not too terrible. So that's my approach. Is Nvidia overvalued? I think it's incredibly undervalued. I don't think people really appreciate how big AI is going to be and how much of a change in the world it's going to be. And I don't think people really appreciate how much of that value is likely to be captured by Nvidia. How will you recover from the Nvidia crash? Not sure I would really call it a crash, but yeah, it went down. When it went down, I bought more, and then it went back up again. So that was nice. And hypothetically, if Nvidia's price goes down a lot without the value changing at all, I'm gonna buy a lot more. So it's sort of, for some investors, they think it's very, very important that their stock price goes up right now. I care only about the value. In fact, my favorite moment is when the value goes up while the price goes down, because then I can buy more of something I think is the value. And quite often I go around celebrating because a company did something that I think increases their value, even though you don't even notice it in the price. But that's when I celebrate. A price rising in the short term is not really a goal. It's the value of the company that's increasing. That's the goal. And the real goal is to be able right now to have companies at a high value at a low price. How will AI impact stock trading? And then there's a second part of the question. So I think in the long term, I don't see why my job or a lot of other jobs that are really focused on communications and being on a computer and talking to people wouldn't be handled by a really, really good AI. So in the long term, it's a question of time of more and more activities being put over to AI until the humans almost out of the loop. Are you implementing AI tools into your own processes? Yes, I use AI every day, and I didn't just start focusing on AI when you all heard about ChatGPT. I knew about OpenAI when they were founded. I saw OpenAI's when they started doing their first project was actually an AI for a computer game called Dota, which was incidentally my favorite game. And when I saw OpenAI's bot playing Dota, that was when I had my big AI moments like, oh my God, this is brilliant. This is gonna take over the world. Then I used GPT-2 and GPT-3 back, when I was reading the patch notes back then. And then yeah, and then my own financial model is also based on a neural network. And I think, yeah, increasingly it'll just be more and more AI focused. What will be the long-term impact of DeepSeek on AI stocks? So I think there's a sort of at least two parts to this question. So firstly, there's just the sort of DeepSeek has in this moment done some incredible implementation of the research that is available to everybody, has made everybody smarter and able for everybody to train AI models with less compute. That still means that you can get even better models with more compute, but that's an improvement. But then you say, like, did that change? Like, some people sort of imagine that whatever change happens, that sort of like should alter your trajectory. But I think like I already have in my models evaluated that we are going to have AI improving because we'll have more compute, but also because we'll have new innovations of how we train models. So sort of, and we're still on the baseline for that, I think. Then there's the other aspect, which is that DeepSeek represents the sort of comeback of China in the AI space. Now we have not just American companies, but we also have a Chinese competitor in this space. And if China can then, manage to build a semiconductor sector so they can have sufficient compute, then they become a real rival in this space in the long term. What is the potential impact of the US making up nearly 70% of global stock market value, but only about 25% of world GDP? So it's little bit less than 70% there that they make up. But nevertheless, the key here is that the US could be making up 100% of the global stock market value, yet only a small part of world GDP, because you can have a company listed in the US and run from US, but that company has activities all across the world, and they might be doing, having factories and selling products and everything around the world. So the company contributes to global GDP, even though it's listed in the US. But fundamentally, having more companies listed in the US does provide some extra power to the to the US regulators, the US government, to the US stock exchanges, and yeah, potentially also the suppliers of those, the investment banks of the US. So it is a little bit of extra power for America to have it this way. but it's not necessarily negative for anybody else, because if America, proves again and again to be a country that takes the legal process seriously, where you can read long documents, where you have good accounting standards and so forth, then you want to have your company listed in America, and you want to invest in a company that's listed in America. So as long as they do a great job at this and people want to have their companies listed there, then they're just, providing a great service that everybody else can access. And so that's really a win-win for everybody. What is your favorite book about investments? So it would be the academic textbooks that I had in my university. So there's one like Principles of Corporate Finance. I don't remember the name, but just a big fat book on statistics, portfolio theory. There's a great book just called Valuation, Measuring and Managing the Value of Companies by three McKinsey guys. And this is sort of if you want to learn a lot about investments, then it's best to start with the academic literature. If you just want to learn a little bit, maybe there are some other easier books one could start with, but I don't really know those books because I don't really feel like picking up a book called, Beginner's Guides to Investments or something. So I don't really know which book there would be good for people that just want to learn a little bit. How can you work every single day, 365 days per year? So I work full days from Monday to Friday, and then I work typically 2 to 3 hours on Saturdays and 3 to 4 hours on Sundays, unless there's something major happening. Then I'll work those days and then do my few hours of work another day. I do that if it's a holiday, then I will just work a few hours every day as well. And yeah, you can also see that on eToro, when anybody writes a comment, I almost always respond within 24 hours. And ultimately, um, I could be researching companies for a million years and I wouldn't get bored when I'm out at a party or something. My mind might very well think about, I wonder how much profit that beverage company is making. I wonder, how much money this bar is making. So I'm always thinking about stocks, and yeah, I think yeah, I'll just continue to do that, and then I find it very, very exciting. So that was my presentation. Thank you very much to everybody for listening. Thank you very much for all the questions, and let's have a great quarter.